All right, America, gather round. Hi, Mr. Market here. Let's talk about the Federal Reserve, or as I like to call it, the Fed. Now, the Fed is like that friend we all have who always controls the music. They think they've got the perfect playlist for every occasion, but sometimes their taste is a little off. The Fed's job is to keep the US economy humming along nicely. They do this by controlling the flow of money, like some kind of financial plumber. But instead of wrenches and plungers, they use interest rates. Think of interest rates as the volume knob on the economy. Crank it up, things get exciting, sometimes too exciting. Turn it down and things calm down, sometimes a little too much. The problem is the Fed is like that DJ who only knows how to blast disco music. They turn the volume up and down, but they don't always know how the crowd will react. Sometimes it takes a while for everyone to feel the beat. So how does the Fed actually control the volume of the economy? Well, they've got two main moves: rate hikes and rate cuts. A rate hike is like turning the volume down. It makes borrowing money more expensive, which slows down spending and cools down the economy. Think of it like trying to buy a giant inflatable swan for your pool. If interest rates are high, that swan suddenly costs as much as a small car, and you might think twice about buying it. On the other hand, a rate cut is like cranking the volume up. It makes borrowing cheaper, encouraging people to spend more, and giving the economy a boost. Suddenly, that inflatable swan is looking pretty affordable, and you're adding it to your online shopping cart faster than you can say monetary policy. Let's rewind to the early 1980s, shall we? Back when shoulder pads were huge, and inflation was even bigger. The US economy was stuck in a disco fever dream of high prices, and Fed Chairman Paul Volcker decided it was time to turn down the music. Volcker, bless his heart, was not afraid to be the uncool guy at the party. He hiked interest rates to record levels, pushing the economy into a recession. It was painful, like ripping off a band-aid covered in glitter, but guess what? It worked. Inflation eventually came down, and the economy recovered. The only problem? It took a while, like a good 3 years, for the effects of Volcker's rate hikes to fully kick in. The dot-com bubble, late 1990s. Fast forward to the late 1990s, the era of dial-up internet and the dot-com boom. Everyone and their pet hamster was investing in tech startups, even if they had no idea what a startup actually was. The stock market was soaring higher than a Taylor Swift song on the charts. The Fed, worried about the economy overheating, decided to gently tap the brakes. They raised interest rates a few times, hoping to cool things down without causing a crash. But remember what I said about the Fed being like that DJ who only knows disco? Well, they might have misjudged the crowd this time. The dot-com bubble burst, the economy went into a recession, and everyone blamed the Y2K bug. The Great Recession, 2008 to 2009. Now let's talk about the big one, the Great Recession of 2008 to 2009. This wasn't just a case of the music skipping. This was like someone spilled their drink on the DJ's equipment. The housing market collapsed, banks were failing, and the global economy was in free fall. The Fed, in a desperate attempt to save the party, slashed interest rates to near zero and pumped trillions of dollars into the financial system. It was like giving the economy a massive shot of adrenaline. And you know what? It worked. The economy slowly started to recover, though it took years to fully heal. The problem is, these low interest rates also led to some unintended consequences like asset bubbles and increased inequality. The lag why patience is a fiscal virtue. So, what have we learned from all this economic history? Well, for one thing, the economy is a complex beast, and even the experts at the Fed don't always get it right. But more importantly, we've seen time and time again that there's a lag between when the Fed takes action and when we actually see the effects on the economy. It's like ordering a pizza while you're hungry. You know it's coming, but it feels like it's taking forever. This lag is why it's so hard to predict the future of the economy. It's also why we need to be patient when it comes to monetary policy. The Fed's actions today might not be felt for months or even years down the line. So the next time you hear someone complaining about the economy, just remember it's complicated. And like a fine wine or a well-aged cheese, sometimes the best things in life take time. Now, if you'll excuse me, I'm going to go invest in some inflatable swans, just in case inflation really takes off.